All right, so we're switching gears. Fed head Jay Powell, remember him? He's speaking tomorrow at their annual conference in Jackson Hole, Wyoming. And the big question is whether interest rates are going to stay high or even keep going higher. The stock market sold off today. Let's ask the great Kevin Warsh, former Federal Reserve governor and a distinguished fellow at the Hoover Institution. Kevin, welcome back on set as always. So you got Powell speaking tomorrow morning, I think 10 o'clock Eastern, and interesting interview today in the Wall Street Journal. Nick Timiraos interviewed Jim Bullard, retired St. Louis Fed, a very smart fella. I want to ask you about Bullard's message, because I think some of that might have been in the stock market sell-off today. He's basically saying, Bullard, the economy is stronger than you think, and interest rates are going to stay higher and maybe go higher than you think. What does Kevin Warsh think?
So I think those are two different questions.
Okay.
The kind of economics that you and I know and practice and think about, we don't think a strong economy is what's the driver of inflation. We think it has something to do with money and credit and the attitude of the central bank that looks like it's trying to been encouraging inflation. On the economy, I got to say, I'm skeptical of the bullish talk on the economy. It might be that the U.S. is an island of prosperity when China's falling fast, Europe's in a recession, and somehow we withstand it. I'm a little skeptical of that idea. Moreover, when I look inside the U.S. economy, that's a lot of government spending. That's a lot of subsidies. That's a lot of special favors for special businesses under the big spending blowout. That's not sustainable GDP. That's GDP that can get you maybe until next November. So I'm a little less bullish on the economy than Jim is.
It's fascinating. The Atlanta Fed GDP Now tracker is almost 6% for the third quarter. Now, I know there's just a few numbers in, but that's a very big number. I think, Kevin, Wall Street, I mean, interest rates have been rising in the longer end of the curve, right? And, you know, for homeowners, for middle-income folks, you got a, 7.5% 30-year mortgage rate, which is a big number. So the question I have is, are rates heading higher? Because a few weeks ago or a month ago, the consensus was inflation's come down, or at least year-to-year inflation, and therefore rates could come down. But that may not be the case, or how do you see it?
So I'll break that into two pieces. First, for the Fed, I think they're fearful of a hot economy. They're fearful that too many people are working. Again, that's not exactly how you and I think about it. But if the economy, if the Fed believes the economy is hot, then they're going to keep raising rates. And my view is if they raise rates to something like 6%, things are likely to break out there. My guess is tomorrow that Jay Powell handles this much more prudently. He uses the fresh air and the altitude at Jackson Hole not to talk about what the heck he's going to do in 6 weeks, but tries to focus on the big picture. I hope he reflects on the big monetary policy errors they've made in the last couple of years, takes stock of the errors in their models, pays some attention to the supply side of the economy. So my guess is we're not going to learn much about how high rates go. But I think the bigger question is the one you asked. Over the last 30 days, 10-year treasuries, that's the most important price in the world, it's moved up 50 basis points. 10-year treasuries are the highest they've been in almost a generation. And that's leading to high mortgage rates, and it's leading to a higher cost for small businesses. I don't think that's quite conducive to the kind of strong economic growth that Jim Bullard was talking about.
But it is market-driven, and my question is, will those rates continue up? So let's say, just for argument's round numbers, the 10-year is at 4.25. Okay, and you're right, it's up 50. It's actually probably, if you go back several months, it's actually almost up a full percentage point. But putting that aside, does the 10-year go to 5%, Kevin Warsh?
I think it's trending in that direction. Yep. You know, the Fed is getting out of this business of suppressing long-term interest rates. That's what their shrinking of the balance sheet's intended to do. And Janet Yellen and the Treasury said very recently they've got $1 trillion of new issuance coming this quarter. Well, someone's going to have to buy that, and I don't think the Chinese are likely to show up and do us any favors.
And it doesn't look like the Fed's going to buy it.
Absolutely not. So the strange thing is you've got the Treasury Department doing all they can to goose the economy. You have the Federal Reserve working at cross purposes, doing all they can to restrict the economy. No wonder this is hard to judge.
Do you give, this important question, I think, for future consideration, do you give the Fed credit for bringing down the year-on-year CPI from 9% and change to 3% and change. Do you give them credit?
Absolutely. I give them.
What'd they do right?
So what they did is last March, they recognized the grievous error they had made for 2 years. It's not easy to admit a big mistake. They have been a little clever of how they've described it, but moving interest rates up 500 basis points is the way to quash inflation. I give them total credit. I just don't want them to get too carried away.
And you're doing very well tonight, by the way. We appreciate this plain speaking. Now, last question, very important question. You've got some people on the left, crazy Paul Krugman and some others, change the Fed's inflation target from 2 to 3% or higher. What say Kevin Warsh on that one?
So that sure sounds like politics masquerading as economics, Larry. Very dangerous stuff to change the inflation target. I am troubled that a lot of the establishment figures, not just Paul Krugman, in the economics profession, think, well, 3% inflation's good enough. I don't. I think it's a way to rob the American people of their savings, do huge harm to the dollar, and probably most important, destroy the credibility of the central bank when we need it
So
most.
keep that at 2%. Even if rates go higher, keep the 2% target.
I would say keep it at 2% and stop talking about these decimal points. The Federal Reserve needs to be in favor of price stability. And if they can do that, then the U.S. economy can be much better off than it would otherwise be.
All right, Kevin Warsh, very outspoken. Pleasure to see you.